Uma crânio não. Uma crânio. Uma crânio não aqui. Não. What has the different thing? Do you stay with your parents?
Yeah.
Well, when you turn around, you go in there and you're staying hostel.
Yeah.
I think.
Makanya makuu.
I think they are very big. Alright, we on the introduction of financial analysis and adaptation. We looked at a number of things. We looked at types of financial analysis. We looked at fundamental and others. May I know where is that to start?
Tools.
The what?
Tools and techniques.
Okay. Alright. Did we list?
Yeah, there were 4.
We listed 4. Of course, they will go beyond that. But let's start with comparative statement. Comparative statement. Comparative statement. Comparative statement. And on comparative statement, what we need to look at is that we try to understand or we try to analyze the information provided in the statement by comparing either of 2 different periods or 2 different entities. But so on there, you write this comparative statement, comparative statement, comparative statement, deal with comparison. Comparative statement, deal with comparison. Comparative statement, deal with comparison. Deal with comparison of different items. Comparison of different items of the profit and loss account. Different items of profit and loss account, of profit and loss account, of profit and loss account, and balance sheet, and balance sheet of 2 or more periods, of 2 or more periods, of 2 or more periods. Most of them. Separate comparative statements are prepared. Separate comparative statements are prepared. For profit and loss account. For profit and loss account. For profit and loss account. As comparative income statement and for balance sheet as comparative income statement, as comparative income statement and for balance sheet, and for balance sheet. As a rule, yes, as a rule, any financial statement represented in the form of as a rule NF. Financial statement can be presented in the form of comparative statement, comparative statement, comparative statement, as a rule, any financial statement can be presented in the form of comparative statements such as comparative balance sheet, comparative balance sheet, comparative profit and loss account, 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 the comparative cost of production statement. I'll tell you where to start. Just a word. I'll say comparative profit and loss account, comparative cost of production statement, comparative cost of production statement, comparative statement of working capital, and the likes. Comparative. So we start. You have comparative income statement. Comparative income statement. Comparative income statement. Comparative income statement. There, right? Three important information. Three important information are obtained from the comparative income statement. Three important information are obtained from the comparative income statement. First of all, they are gross profit, they are gross profit, operating profit, and net profit. Operating profit and net profit Full stop. The changes or the improvement, in the profitability of the business concerned, is find out over a period of time. Is find out over a period of time. Full stop. If the changes or improvement is not satisfactory, if the changes and improvement is not satisfactory, the management can find out the reasons for it. And some corrective actions can be taken. So that is as a operating income statement. So what we just as we said, we need to analyze, and in having an analysis, we try to find out or to see how bad or bad we are, so that we determine what action can be taken. So as we've just seen there, we should be able to understand from the analysis in terms of profitability of the business, how profitable the business is. Where you look at the profitability in terms of the gross profit, you should be understanding the trading profit, buying and selling, how much you are making. Whereas you talk of the operating income, you also try to understand the impact that the expenses or the operating expenses that you incur in order to support the business are impacting on the profitability. Then you go to the other one, you write comparative balance sheet. Last time we reminded ourselves of the balance sheet. Where I did say, if you look at the balance sheet, we look at things that are shown in the statement to show the financial position of the business, where we look at things like assets, capital, as well as liabilities. So they write this. The financial condition, I'm saying comparative balance sheet. So that's the financial condition of the business concerned. The financial condition of the business concerned can be found out. Financial condition of the business concerned can be found out by preparing. Can be found out by preparing comparative balance sheet. Stop. The various items of balance sheet are two different periods. The various items of balance sheet for two different periods are used. The various items for two balance sheets are used. The assets are classified. The assets are classified as current assets and fixed assets for comparison. The assets are classified as the current assets and fixed assets for comparison. The assets are classified as current assets and fixed assets for comparison. Full stop. Likewise, the liabilities are classified as current liabilities, long-term liabilities, and shareholders' net worth. Full stop. The term shareholders' net worth includes equity share capital, preference share capital, reserves. Okay. The term shareholders' net worth includes equity share capital, preference share capital, reserves, surplus, and life. So in this case, that means we should be able to demonstrate such kind of an analysis by having two balances of successive periods, so that we understand how, in terms of liabilities, in terms of assets, we have moved. So the main idea is to say, is it the change that has happened, is it to our favorite, or is it not to our favorite? So we should understand in that way, so that we aid in terms of how we can carry on the decision. Then we go to the other one. You look at common size statements. Common size statements. So when we be looking at the common size statement, what we do is we try to express everything or every item as to the overall. A good example, we may talk of the balance sheet. Let's look at assets. We need to understand how much is the total assets that are there. The total be represented at the 100% of the assets that the company is having. Then we need to compare every asset to the total asset that we are having. Likewise, we do the same when it comes to sales as well as expenses. We talk of the income statement. Rest of it, you write down a vertical presentation of financial information. A vertical presentation, a vertical presentation of financial information is followed. A vertical presentation of financial information is followed. For preparing common size statements. Full stop. Besides the quarter value of financial statement, contents are not taken into consideration. But only percentage is considered for preparing common size statement. The total assets or liabilities, total assets or total liabilities, or sales is taken as 100%, or sales is taken as 100%. And the balance items are compared, to the total assets, and the balance items are compared to the total assets, total liabilities, or sales in terms of percentages, Full stop. Thus, a common size statement shows the relation Thus, a common size statement shows the relation of each component, the relation of each component, the relation of each component to the whole, the relation of each component to the whole. Full stop. Separate common size statement. Separate common size statement. Separate common size statement is prepared. Separate common size statement is prepared for profit and loss account. For profit and loss account as common size income statement, as common size income statement, as common size income statement, as common size income statement. Is that right? And for balance sheet, as common size balance sheet. As common size balance sheet. Is that right? Let's also look at this. You had trend analysis. Trend analysis.
The word trade.
Trend. T-R-E-N-D. Trend. Trend analysis. And on trend analysis, you have this. The ratios of different items. The ratios of different items. The ratios of different items. The ratios of different items for various periods. Ratios of different items for various periods I find out and then compare. I find out and then compare. Find out and then compare under the analysis. And then compare under the analysis. And then compare under the analysis. Full stop. The analysis of the ratios. The analysis of the ratios over a period of years. The analysis of the ratios over the period of years. Analysis of the ratios of the period of years gives an idea of whether the business concern is trending upward or down. Is trending upward or down. Is it right? Are we there? So you go to the last part. In the last part, you write ratio analysis. Ratio analysis. So just as I said last time, here when we do interpretation of financial statement, we will try to interpret the financial statement using ratios. And when we do ratio analysis, we have a number of ratios that we prepare. So all we do is we try to compare the various items provided in the financial report, such as income statement, balance sheet, so that others may understand the position of the business. And in having ratio analysis, we'll be able to see what kind of decision as a management do we need to have. So we have this on that. Right? Ratio analysis is an attempt. Ratio analysis is an attempt. Ratio analysis is an attempt. Ratio analysis is an attempt of developing meaningful relationship. Ratio analysis is an attempt. Ratio analysis is an attempt of developing meaningful relationship, between individual items or group of items, or group of items in the balance sheet, group of items in the balance sheet, or group of items in the balance sheet, or profit and loss account, Is that right? So there, proceed. Relational analysis is not only useful. Relational analysis is not only useful to external, is not only useful to internal parties of the business. Not only useful to internal parties of the business, but also useful to external parties. Relational analysis highlights the liquidity. Solvency, profitability, and capital gearing. So when we analyzing each item, we'll end up with the relational analysis where we try to see how these relations are done. Where you look at total liquidity, where we try to see how the businesses manage what we call the current assets and current liabilities, so that as you manage or you maintain the liquidity of the business. Where you look at the gearing ratio, you look at the composition of the capital structure itself, how you do that, and also you talk of the solvency. You look at it's also a current ratio, but you look at it based on the long term. So let's try to have comparative financial statements. I think the projector is on. Okay. Alright, so if you look at the notes, I've already given you the notes, but now I'm just go to straight. I've given some sort of summary, but I'll also give you what I've done with the chapter. I'll give you these notes. But what I would like to do here is we should see how exactly we can prepare those comparative financial statements. We have given notes on that. So we have this part. That's it. The following illustration makes clear understanding. There's an illustration one from the following profit and loss account and balance sheet of Lamco Limited for the year ending 2003 and 2004. You are required to prepare comparative income statement and comparative balance sheet. Remember, what I said under the comparative statement is we try to compare two statements or so of various periods so that others can understand whether the company is going upward or going downward. So here, these are the statements that we have. Thank you so much. If you have those two statements, you have the first one, you have the profit and loss account, that is profit and loss account for year 2003 and 2004. Likewise, you do have the balance sheet for the very respective year. So we are saying we need to come up with a comparative statement. The question is, how do we prepare a comparative statement from those two? So if you look there, if we may come down here, what we have is, we have like, this is the comparative statement. Where if you look at the structure itself, we have here and see down all the other side, whether there has been an increase or a decrease. If you look here, that means we have these columns whenever we try to prepare the comparative statement. And at the end here, we are doing the analysis whether there has been an increase or a decrease. And from there, we need a good example. Let's look here. We are saying increase or decrease, where absolute 2004, percentages for 2004. That is to say, if you look at in terms of sales came 2000. I mean sales 2003, we had 8,000. 2004, we had 10,000. There was a jump of what? 2,000. So the question is, how much has it increased? Where do you have the class 5? Any thought with regard to the notes that I've just given you? Where do we have that plus 5? So there, in terms of plus 5, we need to compare with the origin there. If you see there, in terms of sales, you find that the total sales were what? If you do like 2 over what? 2 over, let's try 2 over the original sales, which is 8,000. Can you divide 2 divided by 2,000 divided by 8,000? How much we get? You get what? You get 25. That has been the increase. Likewise, you go for cost of sales. We had 6,000 in these ones are here. We are not taking them from somewhere else. They are coming from here. We start with sales. So it's like in here, you're preparing nothing but you're preparing the very same income statement, but now you are combining these two income statements. Such that you have the very same layout. We have, if you look here, in order to prepare income statement, we have sales, cost of sales, then we come up with the gross profit, right? From the gross profit, you take off all operating expenses, so that at the end, you end up with what? The net profit. You recall those kind of stuff? Or it's hard? You want? You recall? The way we prepare the income statement, where we have things like, let me do this. So In short, income statement. The income statement. The way an income statement is prepared, we first start with what? Sales. Put them here. Then we list cost of sales. And in cost of sales, what we have is what? We have purchases. We add from purchases, we have opening stock. We have list closing stock. And what we end up with here is what? The cost of sale. If you take the cost of sale from there, you have what we call the gross profit. Then after this gross profit, you write again admin expense. Where we have things like, what would this be? Rent. We have rent. So let's put them a bit inside. Rent, salaries, depreciation, rates, and heating, all this kind of stuff. You told them you get here, what you have down here is the net profit. So, what we are looking at here is that we should be able to come up with something like this based on the information that we have been given. So, we have been given these two statements here. These two statements. That is, if you are those statements, if we had come up with the income statement here, from this account, we need to take sales. Then from sales, we need what? Cost of goods sold. And in this case, cost of goods sold has already been given 2001, 2003, it was this one. This one is this one. Then we need to take also what? Admin expenses. If you hear what admin expenses, they are just given what? Administrative. They are given operating expenses. They are given administrative savings. They were only two. Then you get what? You get the net profit. I feel like in terms of writing, there was a mistake there. We have this one should be here. Let us should be this. No. Okay. So you take those information that have been given and put them into this one. Then you come up with what we call the comparative statement. So it's like you have extra columns so that as you incorporate both years, 2003 and 2004. Are you following? Or it's confusing? I think notice to navigate so that you shouldn't write it in your notebook, but you should just be following it there, right? Alright, you remember most legacy than how. So if you look there, if you go all the cooperative income statement, we have this one. So now sales. We are seeing sales to the there is a difference of 2,000. If you see the increase or the decrease, we just compare the two. And I say to find the 25 there, you did what? 2,000 divided by 8,000. You got 25. Let me a simple example. We say the origin was 8, right? Yeah. The difference is 2,000. So you were dividing what? 2,000 divided by 8,000. You get what? This one. Then this one is what? 100. You get 25. So you just have one thing that you have to know is we should see what is in the origin now. Now if you go there, if you go like that one, we're saying we need to reduce our cost of sales. The question is, what were cost of sales in 2004 and 2003? So if you see here, you get up here, we have what? 600, 875. There is a difference of what? 1.5. Nearly, in this case, our difference has been 1.5. Then 1.5 should be expressed in terms of what? The original cost of sales, which is for 2003. So if you add 1,500 divided by 1.5 divided by 6,000, right? You get this. Then this time, and you have those kind of stuff. So if you go there, you find that everything has been done just like that. So at the end, you find that this is the comparative income statement. And if you look at this comparative income statement, we can ever see and interpret the information that has been presented there as whether there was a decrease, or there was constant, or there was an increase. So it's one of the simplest things. If you see here, the above statement shows that though the sales have gone up in 2004, the rate of gross profit remained 25%. The cost of goods sold and its percentages remain 25%, and the selling expenses remain the same. But selling expenses have been increased. This is due to increase in the sales. The rate of the net profit also has increased. So all we need to do is we should be able to go deep and figure out. By the say there has been this increment or there has been this decrease, say why. And how to say why? The question is, from the management point of view, what kind of an idea or what kind of a decision do you need to take so that either you maintain the goodness or you bring an improvement wherever there was what? No improvement. Are we there?
So, how many percentage you
you mean like here? You mean say here you are this and this? No. Here again, you see here, we're talking of this gross profit, right? What has happened? The previous gross profit was this one. Okay, let me present it this way. When you're doing this analysis, that means we're doing the analysis for what? 2004. So we're comparing this 2004 to the previous year. So if you look here, that means our gross profit previously was 2,000. And the question is, what profit has it increased? It has not increased by this. So you need to compare this increment to the original one. So it will be this divided by this.